Welcome back. So this week I'm actually in a different place. You can see the background looks a little bit different from what you normally would see. I'm actually in Denver, Colorado for a real estate investing conference and event that I'm super excited about. I like to network, meet new people, and just learn a bunch of new stuff. So I'm here just recording this thing before all the exciting event starts this evening. So this week we're going to talk a little bit about working with lenders. A lot of us have, gotten loans through for our houses and stuff like that, which is you qualify through your W-2 income and make sure you can pay off your loan. When it comes to investment real estate, the lenders look at us a little bit differently because it's it's an investment. We're not going to live there, and we're trying to make money on it. So traditionally, lenders will look at two different ways. One is like smaller deals in the 1 to 4 unit, and for those types of loans, they're going to look at having a down payment of 20 to 25%, steady W-2 income, good credit, and then some liquidity to be able to cover loan costs and expenses. And also they may look at some of the income on the property that you're buying to be able to cover your loan. But quite often it's kind of a mix of your own ability to repay the loan and then the property's ability to service that debt. When we go to larger properties, anything above 4 units, and here I'm probably referring to, 1 or 200 units, the lender is going to look really beyond your personal ability to service a loan, because it doesn't make sense that you personally can pay a mortgage at $5,000 or $10,000 a month. So in that sense, the bank is going to underwrite your property differently. First of all, you still need money for the down payment or the equity, still 20 to 25% depending on the market and the deal. And that can come from personal funds if you have saved up a lot of money. It can come from partners, or it can come from investors, as long as you can raise that money and to be able to close on the deal. But you also need to have experience, multifamily investing experience, and especially on larger properties, lenders going to look very carefully at that. So you don't go out and buy your first property is $200 and you buy it by yourself. The bank is not going to look favorably at that. So in this case, you need to partner with people. If you are a beginner, you need to partner with people that have done these types of deals. The first larger property we bought was 38 units, and we partnered with our property manager on it. There, the bank was more likely to lend us the money. You also typically need to have a net worth equal to the loan amount. So if you're borrowing $10 million, you and your partners, the key principals on the deal, need to have $10 million in net worth, not liquid net worth, but net worth in other investments and properties and so forth. You need to have liquidity to cover several months of expenses and loan payments. Don't buy a apartment building with your last dollar and then hope that you get enough rental income to pay. You need to show the bank that you have several months of liquidity in the bank to be able to cover these expenses. And also, as I talked about before, the property needs to be able to cover the debt. It's going to have a debt service coverage ratio on 1.25 or higher. So the underwriting is a little bit stricter. It is, commercial underwriting, so there's a lot of ways to negotiate and work with lenders. And having a personal relationship with a lender is really important. And some banks are much more willing to lend on multifamily than others. Some may only give a 20-year amortization, but others will give you 30 in terms. So really spend the time connecting with lenders, understanding what their loan programs are before you go out and get that property under contract. Again, as I talked about, you need to pass these lender requirements, and to get through those hurdles, it's really, again, back to this idea of teamwork. If you don't have the experience, you can partner with somebody who is experienced. If you don't have the net worth, maybe you partner with some high net worth individuals. Whatever it is you're missing in that picture, go out and find that. And you may have to give them a share of the deal. If they're just lending their net worth, they don't have to sign on the debt and stuff like that. You may need to give them a share of the deal just to lend them to help you close this deal. And something I didn't mention here is also the idea of a non-recourse loan. Some of these larger loans are non-recourse, which means that you're not personally liable for paying back the debt. So if the property fails, which obviously you don't want to happen, but in that case, it's only the bank's ability to recover the loan amount back from the property versus you personally. There are still carve-outs for, you know, fraud and bad actors and stuff like that, but in general, you are not liable for it. This also helps when you're partnering on something. Maybe you don't want a lot of people to, or people don't want to sign on the debt. And this idea of teamwork, I mean, that's one of the things why I'm here in Denver now, is to really just meet with people, network, expand my team, and find people that can help me achieve my goals and that I can help them achieve theirs. As always, if anybody's interested in connecting with me, talk about real estate or anything else of that nature, go ahead and go to my website, opendoorscapital.com/call. I also have an investor portal there if you want to sign up and look at some of the deals that we are raising money for or the deals we have close in the path. Go ahead and look at that. And if you want to send me an email, jens@opendoorscapital.com. So next week, we are going to talk about managing properties. Now we've went through the due diligence, we've found the loan, we've closed on the property. So now we figure out how can we really manage this deal to make our business plan come true.